Why they really halted trading. The truth. They're concealing. They didn't stop the market to protect you. They stopped it to protect themselves. While you were locked out, unable to buy, unable to sell, positions worth billions were quietly being moved. The halt lasted hours. The damage lasted much longer, and the official explanation? It was never meant to satisfy you. It was meant to silence you. What really happened inside those frozen markets is something they hoped you'd never piece together. Until now. Welcome to Financial Crisis Explained, the one place where the numbers don't lie and the story doesn't stop until the full truth is on the table. Now, before we go any further, if you found this channel for the first time, subscribing takes one click. Think of it like adjusting your reading glasses before an important document. Just one small move that makes everything clearer. Don't scroll past it. Your future self will thank you. And one more thing, where in the world are you watching this from right now? Drop your city, your country, anything in the comments below. Because what we're about to uncover affects every market, on every continent, including yours. On a Wednesday that most retail investors will not forget, the market did something it rarely does in plain sight. It stopped. Not a slowdown, not a correction, not the kind of gradual decline that gives a careful observer time to think, to breathe, to reposition. A full halt. A complete suspension of trading activity that froze millions of participants mid-decision, hands on the wheel, foot on the accelerator, and suddenly, no road ahead. The official explanation arrived quickly. It almost always does. Regulators cited volatility concerns. Exchanges pointed to circuit breaker protocols. Financial media began its familiar choreography. Anchors speaking in calm, measured tones, graphics cycling through technical jargon, and carefully selected analysts reassuring viewers that this was standard procedure, that the system was working exactly as designed, that investors should remain calm. And most people did, because most people trusted the institutions delivering the message. That trust, as this analysis will demonstrate, is precisely what those institutions were counting on. When a trading halt is announced, the public receives a version of events. That version is not fabricated outright. It contains enough factual scaffolding to appear credible, but what it consistently omits is more revealing than what it includes. The official narrative surrounding this particular halt followed a well-established template. First, the language of protection. Regulators framed the halt as a safeguard, a mechanism designed to prevent runaway volatility from harming everyday investors. The halt, they said, was the system catching itself before a fall. Second, the language of normalcy. Spokespeople emphasized that circuit breakers exist for exactly these situations, that their activation was not a sign of crisis, but of competence, that markets, upon reopening, would stabilize and resume their natural function. Third, and most critically, the language of closure. Official statements were worded to signal that the matter had been handled, that questions had been answered, that the appropriate parties had reviewed the situation and found no cause for further concern. For the average investor watching from home, this three-part message was designed to accomplish one thing above all else: to end the conversation before it truly began. Now examine what the data actually showed in the hours surrounding the halt. Silver dropped to 87, then to the 87.20 to 89 zone, a range that experienced analysts had previously identified as a former resistance level transitioning into new support. Price bounced back to 90, suggesting that support was holding. Then it failed, hard. Silver dropped again to 85, stabilizing briefly at 86. The 150 exponential moving average sat directly at 85, a level that had historically acted as support during previous periods of institutional pressure. These are not random numbers. In isolation, they might appear to be ordinary market fluctuations, the kind that occur dozens of times each trading session. But when examined against the backdrop of what was happening at the institutional level simultaneously, a very different picture begins to form. Because while retail investors were processing the halt, absorbing the official explanation, and deciding whether to hold or exit their positions, institutional players were not waiting for clarity. They already had it. Here is what no regulatory statement addressed. Here is what no financial anchor asked on air. Here is the question that was conspicuously, deliberately, and strategically absent from every official communication surrounding the halt. Who benefited from the timing? Not from the halt itself in abstract terms, not from the concept of circuit breakers as a protective mechanism in theory, but from this specific halt, on this specific day, at this specific price level, with a specific configuration of institutional positioning already in place. That question was not asked publicly. And when a question of that magnitude goes unasked in the aftermath of a market-wide event, it is rarely because no one thought to ask it. It is because someone, somewhere, needed it to go unanswered. There's a moment in every engineered market event when the evidence stops being circumstantial, when the timeline stops looking like coincidence, when the positioning, the timing, the volume, and the silence from official channels align so precisely that the only honest conclusion available to a serious analyst is this: someone knew. Not suspected, not anticipated through superior research or sharper instincts. Knew. And that distinction between knowing and guessing is worth billions when a halt freezes an entire market and only one category of participant enters the reopening with their strategy already intact. The 48 hours. Nobody talked about. Markets do not halt in isolation. They halt at the end of a chain of events, a sequence that, when examined carefully and without the distortion of official framing, reveals a pattern of preparation that retail investors are never meant to notice in real time. In the 48 hours preceding Wednesday's halt, something was moving beneath the surface of the silver market that deserved immediate scrutiny and received almost none. Options activity shifted, not dramatically enough to trigger alarm in mainstream reporting, but measurably, consistently, and in a direction that would only make sense to a participant who understood what was coming. Put options, instruments that gain value when prices fall sharply, were being accumulated in quantities that fell just below the thresholds typically flagged by surveillance systems. This is not speculation. This is a documented behavioral pattern among institutional quantitative trading firms operating in commodity and ETF markets. The accumulation is calibrated. It is designed to remain beneath the noise floor of regulatory detection while still being large enough to generate extraordinary returns when the engineered price event finally executes. The halt was not the beginning of the story. It was the moment the story became visible to everyone else: Jane Street and the $1.3 billion signal. Then came the disclosure that reframed everything. Jane Street, one of the most sophisticated quantitative trading operations on the planet, had added 20.6 million SLV shares in Q4, making them the largest single holder of the silver ETF, with a position valued at approximately $1.3 billion. The financial media reported this as a footnote, a data point, a quarterly filing buried beneath more immediately dramatic headlines. It was not a footnote. It was a declaration of strategic intent. When a firm of Jane Street's caliber, a firm whose entire operational architecture is built around extracting edge from markets through superior positioning, superior timing, and superior understanding of how retail participants behave under pressure, accumulates a $1.3 billion position in a single commodity ETF. They are not making a passive investment. They are building infrastructure for an event. And the event, for those paying attention, had already been partially announced by the position itself. How a halt becomes a liquidity. Extraction tool. Here is the mechanism that official explanations are structurally designed to prevent the public from understanding. When institutional players accumulate enough of an asset to meaningfully influence its price action, they acquire something far more valuable than the asset itself. They acquire the ability to manufacture the conditions under which retail participants make fear-based decisions. The halt accelerates this process, because a halt does not affect all participants equally. Large institutional desks maintain direct lines of communication with exchanges, clearinghouses, and, in some documented cases, regulatory bodies themselves. Their risk management infrastructure operates continuously. Their algorithms are repositioning in milliseconds, even as the public-facing market sits frozen. Retail investors, by contrast, are completely blind during a halt. They cannot execute. They cannot hedge. They cannot respond to new information in real time. They can only wait, accumulating anxiety, reassessing their positions without the ability to act on those reassessments, and arriving at the reopening bell in a psychological state that institutional players have studied, modeled, and prepared to exploit with clinical precision. The halt, in this context, is not a pause in the game. It is a move in the game, a move that only one category of participant is positioned to make. The architecture completes itself. Now bring these elements together, as a serious analyst must. A $1.3 billion institutional position established before the halt. Options activity calibrated beneath detection thresholds in the preceding 48 hours. A retail investor base frozen during the halt and psychologically destabilized upon reopening. And an official narrative so thoroughly focused on the mechanics of circuit breakers that it left no space, not one sentence, for the question of who entered that halt already knowing how it would resolve. This is not market volatility. This is market architecture. Built deliberately, executed precisely, and explained to the public in language carefully chosen to ensure that the architecture itself remains invisible. The structure has been identified. Now it must be traced back through history, because this is not the first time it has been built. There is a particular kind of comfort that power relies upon, not the comfort of luxury, not the comfort of security, the comfort of repetition. When something happens often enough, in roughly the same sequence, producing roughly the same outcomes for roughly the same category of beneficiary, it stops being an event It becomes a system. And systems, unlike isolated events, can be studied, mapped, anticipated, and ultimately understood by anyone patient enough to trace the pattern across decades rather than days. What happened on Wednesday was not born on Wednesday. It was rehearsed. The first time. The playbook was used in plain sight. To understand where the current moment sits in the larger historical arc, one must return to January 2021, GameStop. The name alone carries weight in financial circles, not because of what the company is, but because of what that episode revealed about the relationship between institutional power, retail participation, and the mechanisms of market control that exist quietly in the background of every trading session. When retail investors, coordinating through online communities, began driving GameStop's share price upward with enough velocity to threaten the short positions of several major hedge funds, the response from the institutional infrastructure was swift, coordinated, and devastating. Trading was halted, not by regulators responding to systemic risk in the traditional sense, but by a clearing infrastructure, specifically Robinhood's decision to restrict buying activity at the precise moment that restriction would cause maximum damage to retail momentum and maximum relief to institutional short exposure. The official explanation cited capital requirements, collateral obligations, the technical demands of clearinghouse protocols. Sound familiar? The language was different, the asset was different, the decade was different, the architecture was identical. Retail locked out, institutional players repositioning, price action moving in the direction that served the largest, most sophisticated, and most politically connected participants in the market, and a public explanation delivered with enough technical complexity to discourage the average investor from asking the next logical question. Commodity freezes and the longer history. But 2021 was not the origin point of this playbook. It was merely its most visible modern execution. Travel further back to 1980. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, had accumulated a silver position so substantial that it threatened to corner the entire market. As their position drove silver prices to historic highs, the institutional and regulatory response was immediate and coordinated. COMEX changed its trading rules mid-game. Position limits were suddenly imposed. Margin requirements were dramatically increased. Not gradually, not through standard regulatory process, but rapidly and specifically in a manner that forced the Hunt brothers to liquidate their positions under catastrophic conditions. Silver collapsed. The Hunt brothers lost billions, and the official explanation focused entirely on the danger of market manipulation by the Hunt brothers themselves, while the simultaneous manipulation of the rules governing their positions received almost no equivalent scrutiny. Who benefited from that collapse? The same category of participant that benefits from every engineered price event. Those who were short, those who held puts, those who had positioned themselves on the correct side of a move they either anticipated or, in the most serious interpretation of the available evidence, actively engineered through their influence over the rulemaking process itself. Regulatory capture and the revolving door. This brings the analysis to a structural reality that serious economic observers have documented extensively, but that mainstream financial media treats as too uncomfortable for sustained examination. The individuals who design market regulations and the individuals who benefit most from how those regulations are applied are, with remarkable frequency, the same individuals, separated only by the titles they hold at different points in their careers. This is the revolving door. A senior figure exits a major quantitative trading firm and moves into a regulatory oversight role. They bring with them an institutional understanding of how sophisticated players operate, an understanding that is theoretically meant to sharpen regulatory effectiveness, but that in practice creates a supervisory environment that is structurally sympathetic to the very participants it is meant to police. Years later, that same figure exits the regulatory role and returns to the private sector, frequently to a firm that benefited from decisions made during their tenure in oversight. This is not conspiracy. This is documented career history, available in public filings, in Senate confirmation records, in the professional biographies published by the firms themselves. The revolving door does not merely create conflicts of interest. It creates a governance architecture in which the most consequential market decisions, including decisions about when to halt trading, under what conditions, and with what advance notice to which parties, are made by individuals whose deepest professional loyalties have never fully left the institutional world they nominally oversee. The media's role in the timing. There's one final component of the documented playbook that demands examination before the pattern can be considered complete: the media. Not as a monolithic conspiracy, not as a single coordinated entity receiving instructions from institutional players, but as a system with its own incentive architecture, one that reliably produces coverage that serves institutional narratives at precisely the moments when alternative coverage would be most dangerous to institutional interests. When the GameStop halt was executed, financial media spent the following 72 hours explaining why retail investors had behaved irresponsibly. The systemic questions about who authorized the halt, under what legal framework, with what advanced communication to institutional desks, received a fraction of the airtime. When silver dropped through critical support levels following Wednesday's halt, the coverage focused on price targets, technical levels, and analyst sentiment. Not on the $1.3 billion position that had been established before the move. Not on the options activity in the preceding 48 hours. Not on the identity of the participants who entered the reopening already positioned for exactly the price action that materialized. This is not accidental editorial oversight. This is the media functioning precisely as the institutional ecosystem requires it to function, covering the surface, protecting the depth. What the pattern proves across 1980, across 2021, across Wednesday. The playbook does not change because it does not need to change. It works because retail investors are never given the complete picture in real time, because official explanations arrive before independent analysis can organize itself, because the media covers the event while the architecture behind the event remains untouched. But patterns, once identified, cannot be unseen. And the investor who understands the playbook is no longer playing the game the way the game was designed to be played, which raises the only question that now matters. When the game is documented, when the playbook is mapped, when the architecture is visible, what does a serious, informed participant do next? There is a particular moment in every serious investor's education that cannot be taught in a classroom, cannot be found in a textbook, cannot be delivered through a quarterly earnings report or a regulatory filing or a carefully worded statement from an exchange spokesperson. It is the moment when understanding replaces hope, when the investor stops asking, when will the market be fair, and starts asking, how do I operate effectively inside a market that was never designed to be? That shift from hope to understanding, from reaction to anticipation, is not pessimism. It is the single most important cognitive transition a serious market participant can make, and it begins here. The difference between reacting and reading. Every retail investor who lost money during Wednesday's halt shared one common experience. They were surprised. The halt caught them mid-position. The price action that followed caught them mid-decision. The official explanation caught them mid-question. And by the time clarity arrived, or the appearance of clarity that official narratives provide, the damage had already been recorded in their portfolios. Surprise, in a market context, is never random. It is manufactured. The institutional players examined throughout this analysis do not experience market halts the way retail participants do. Not because they possess illegal foreknowledge in every instance, though documented cases of that exist, but because they have built analytical infrastructure specifically designed to read the signals that precede engineered volatility events. Those signals were present before Wednesday's halt. The 48-hour options activity was a signal. The Jane Street accumulation disclosure was a signal. The price behavior around the 87.20 to 89 support zone was a signal. The 150 EMA sitting at 85, a historically significant confluence level, was a signal. None of these signals required insider access to interpret. They required only the discipline to look at the complete picture rather than the fragment that financial media chooses to illuminate. Serious participants read the complete picture. They build their decision-making around what the data suggests rather than what the narrative insists. And when the halt comes, as it will come again because the playbook does not retire itself, they are not surprised. They are positioned. Risk architecture for an engineered volatility environment. Understanding. The playbook is the first layer of protection. Building a risk architecture that accounts for engineered volatility is the second, and it is where understanding converts into actual capital preservation. In practical terms, this means several things that conventional financial advice consistently underemphasizes. First, position sizing that accounts for manufactured price swings rather than natural volatility alone. The standard models used to calculate appropriate position size assume that price movements reflect genuine market forces. In an environment where institutional players are engineering those movements for extraction purposes, those models systematically underestimate the magnitude of potential drawdowns. A serious participant adjusts the model. They size positions with the understanding that the next move could be institutional in origin, meaning faster, deeper, and more sustained than natural volatility would produce. Second, optionality preservation. The investors who navigate engineered volatility events most effectively are not those who predicted the exact direction of the move. They are those who maintained enough undeployed capital to act when the engineered move created genuine value opportunities. When silver dropped to 85, to the 150 EMA confluence level that institutional players know retail analysts are watching, that was not merely a support level, that was a harvesting point. A location where institutional selling pressure had driven price to a level that would trigger retail stop losses, generate panic exits, and create the kind of dislocated pricing that sophisticated buyers accumulate into, quietly, systematically, and without announcing their intentions to the market. The serious participant who preserved optionality could act at that level. The retail investor who was fully deployed before the halt could only watch. What informed participants knew about the next move. Now bring the technical and institutional picture together as it stood in the aftermath of Wednesday's halt. Silver at 86. The 150 EMA at 85, holding as historical support. The 87.20 to 89 zone now functioning as overhead resistance. Former support flipped by the institutional selling pressure that accompanied the halt. And a $1.3 billion position held by the most sophisticated quantitative trading operation that entered this event with their strategy already constructed. This configuration communicates something specific to an analyst reading it without the distortion of official narrative. The extraction phase is not complete. When institutional players of this scale build positions of this magnitude, the cycle documented in part 2 of this analysis, accumulate, engineer volatility, harvest retail panic, reaccumulate at lower prices, create FOMO on the way back up, repeat, does not conclude in a single halt event. It concludes when the maximum possible value has been extracted from the maximum possible number of retail participants. Wednesday was not the conclusion. Wednesday was the middle, which means the signals that preceded Wednesday are now the template for reading what comes next. The options activity, the institutional disclosure patterns, the behavior of price around key technical confluences, the tone and timing of official communications. These are not background noise. They are the language in which the next move is being announced to those who have learned to read it. The strategic framework going forward. For the serious participant, the aspiring entrepreneur, the disciplined investor, the business mind that approaches markets as systems rather than gambling mechanisms, the framework that emerges from this complete analysis is built on 4 principles. The first principle is perpetual skepticism toward official explanations. Not cynicism, not conspiracy thinking. Disciplined, evidence-based skepticism that begins every analysis with the question that official narratives are designed to prevent. Who benefits from this, and when did they position for it? The second principle is signal literacy, the ability to read institutional footprints in options activity, in ETF positioning disclosures, in the behavior of price around historically significant technical levels. These signals are publicly available. They require only the analytical framework and the patience to interpret them correctly. The third principle is emotional detachment from price action. The entire institutional playbook depends on retail participants making fear-based decisions during manufactured volatility. The investor who has internalized the mechanics of how that volatility is created is structurally less vulnerable to the psychological pressure it is designed to produce. And the fourth principle, perhaps the most important of all, is continuity of attention. The institutions executing this playbook are counting on short attention spans. They are counting on retail investors who follow a story for 72 hours and then move on to the next headline. They are counting on the cycle completing itself before the pattern becomes visible to enough participants to meaningfully disrupt the extraction. The serious investor does not give them that advantage. The final word markets are not broken. They are functioning exactly as the most powerful participants within them designed them to function. The halt was not an accident. The timing was not coincidence. The official explanation was not incompetence. Every element of what occurred on Wednesday, the positioning, the halt, the price action, the narrative, the silence around the questions that mattered most, was the output of a system operating with precision. The only variable that system did not account for is the participant who understands it completely. That participant cannot be harvested through panic, cannot be extracted through manufactured volatility, cannot be silenced by an official explanation designed to end conversations before they begin, because they already know what the explanation is concealing, and knowledge, in a rigged game, is the only edge that cannot be taken from you.